Welcome back to Cracking the 401k, your one-stop journey through the twists and turns of your retirement plan. In our last episode, we navigated the rugged terrain of hardship withdrawals. And today, we reach a pivotal mile marker on the retirement highway, age 59 and a half. That's right, the magical age when your 401k door starts to creak open, no penalties attached. So buckle up, because today we're going beyond just age. We'll talk about the freedom to withdraw, the smart use of rollovers, and the final chapter, distribution day. Let's dive in. Picture this, you're 59 and a half, still working, still contributing to your 401k, but now, the locks are off. You're now eligible for something called an in-service withdrawal. It's like getting the keys to a room you didn't know existed in your financial house. If your plan allows it, you can now access virtually all types of vested contributions. Before tax, Roth 401k, employer matches, even rollovers. Earnings? Yup, they're in the pot too. But here's where it gets interesting. The plan sponsor, aka your employer, gets to set the order in which these funds are withdrawn. We call this the withdrawal hierarchy. A typical one might look like this: grandfathered after-tax contributions, non-grandfathered after-tax plus earnings, rollover money plus earnings employer contributions, hardship-eligible employee before tax, and Roth 401k, and finally, your regular before tax and Roth 401k dollars that become fully available at age 59 and a half. Now, the biggest perk here? No 10% penalty tax. That's the IRS giving you a thumbs up for reaching retirement halftime. But, unless you roll it over, expect a mandatory 20% federal tax withholding. You'll also receive a 1099-R form next January. So, yes, you get freedom, but always read the fine print. Now let's say you've got your eyes on greener investment pastures, maybe a brokerage IRA with more options or just better fees. That's where in-service rollovers come in. Instead of taking a cash withdrawal, you can roll your funds over to another employer's 401k plan, a traditional IRA, or if you're feeling adventurous, a Roth IRA, though keep in mind that's a taxable move. This is especially appealing if you want access to professional advice, a different investment strategy, or just want to consolidate multiple accounts. The best part, no taxes or penalties on rollovers, as long as they're done correctly. It's like moving houses without paying a moving fee, if you plan it right. Requesting a withdrawal isn't like hitting an ATM. You'll likely need to choose the type of withdrawal, enter the amount, percentage, or dollars. Decide if you want a rollover for any portion. And, here's a cool feature, some plans offer a gross-up option. Now, what's that? Imagine you need exactly $1,000 in your hand, but taxes eat away 20%, right? Without gross-up, you'd only see $800. But if your plan allows it, the system can gross up your request to $1,250. So after taxes, you still walk away with $1,000. Neat, right? Also note, withdrawals are often processed daily, but cutoff times and check delivery can vary. Some plans process once a week, even if they value accounts daily. Patience matters here. Eventually, the time comes when you're no longer with the company. Maybe you're retired, disabled, or simply moving on. That's when you become eligible for what's called a final distribution, the big cash out or transition of your 401k. Here are your options. Take a lump sum. Just be ready for the taxman and possible penalties if you're under 59 and a half. Roll over the balance. Keep the tax advantage status by moving funds to another retirement account. Installments? Think of it like your own custom pension. 10 annual payments, 20. It's up to your plan's rules. Annuities, rare but possible. This turns your balance into a series of lifelong payments. Leave it in the plan. If your balance is above a certain threshold, you might just sit tight and let it grow. But be careful of small accounts. If your balance is below $1,000, you might be cashed out automatically. Between $1,000 and $5,000, the plan may roll you over to a default IRA. Always read those plan emails. Silence can lead to automatic decisions. 59 and a half is more than a number. It's a pivot point. You get access, flexibility, and choices, but with freedom comes responsibility. Understanding taxation, timing, and strategy can make the difference between early empowerment and regret at tax time. And final distribution, that's the true finale. The moment your 401k steps aside and your retirement begins in full. In our next episode, we'll explore the world of loans, required minimum distributions, and that often misunderstood concept, involuntary cash outs. Until then, stay informed, stay empowered. And remember, your future self is already thanking you.